I'm here to talk about mortgage note investing, which is a real estate-backed investment option. You can do it active or passive, so I'll kind of cover both. But a little bit about who we are and our backstory, I think, is really important to when we talk about the Reg A, an intro to mortgage note investing, why 70, and kind of some current opportunities that we have before opening it up to Q&A. So at 70, again, we are specialized in fix and flipping residential mortgage notes secured by single-family homes throughout the US. And essentially what that means is that we're buying these notes at a discount and reworking them with the borrower and then selling them for a profit back to the secondary market. So really creating these win-win solutions for both our borrowers, our investors, and the company as well. I guess that'd be win-win-win. But really, this all started back when I was working at a tech company. Chris and I both worked corporate W-2 jobs. We didn't know each other. And I was coaching a local high school water polo team as a volunteer coach. I played water polo in high school and college. And it was my way to kind of not always be in an office and give back to the community that I was living in. And when I looked around at the parents that were always showing up, it was parents who own their own business or invested in real estate or both. So I started reading, attending RIAs, showing up to webinars like this, educating myself on self-directed IRAs, and eventually landed on mortgage notes because I liked the idea of being a lien lord, the bank, versus a landlord. So built my own portfolio where I managed probably about 50 loans secured by single family homes. When I met Chris, we partnered together, ran a ton of joint ventures with individual investors. And this really was kind of what started the Reg A, because Chris and I both came from W-2s and weren't always accredited. And so we realized that all these people wanting to do joint ventures, mostly it's because they didn't have access to other funds that would allow them to invest because they weren't accredited, or maybe they were, but they were first delving into alts, the alt space, which that word needs a complete rebrand. But and the minimums on a lot of the accredited funds are $50,000, $100,000, which is a lot to put in to a single investment that you might be your first alternative investment. So the Reg A started as our mission to really provide investment opportunities to everyone, make it accessible, have a minimum that's available to people. And that's kind of where the Reg A came from. So overview of the mortgage note industry. Like I mentioned, whenever I tell people this is what we do, they always look at me like with a blank stare because typically it's not something you've heard of. But if you've ever received a letter in the mail, if you're a homeowner listening right now, and you've ever received a letter in the mail that said, your loan has been sold from Chase Bank to Union Bank. Please send your future mortgage payments here to Union. That's what we do. That is a loan being sold. Now, some fun stats. If a loan was held for 30 years, it would be sold an average of 7 times. So it's very common that these loans are bought and sold from institution to institution, fund to fund, even if they are paying on time. So it's a $16 trillion market with anywhere from 250 billion to 500 billion in non-performing debt floating around. So, again, what we're doing at our scale is really like us picking up a speck of sand on a beach. It is a massive market. And mortgage note investing in itself essentially is an alternative investment strategy secured by physical real estate. A lot of our investors that we work with love it because they understand investing in homes, rentals, Airbnbs. And so what we're doing is we're buying these loans from private banks, private lenders, whole loan traders, credit unions, hedge funds, and we're purchasing these notes at a discount, typically because they're distressed, meaning the borrower hasn't paid in 90 days or more. But then even the performing notes, meaning the borrower is paying on time as expected, we still get those at a bit of a discount. So we're purchasing these notes at a discount, and then we're essentially buying the rights to the borrower's future mortgage payments and the right to repayment according to the terms of the note. So if they default, we have the right to foreclose. So again, lots of exit options, which I will get into here shortly. Types of loans, and I've used these words a few times, so I should probably move this slide up. Performing and non-performing. Performing, borrowers making payments and meeting their repayment obligations. They purchase loans at a slight discount and we collect the payments, or they're short-term performing loans for real estate investors and we collect fees and payments. Then you have your non-performing. And now this makes up about 60% of our portfolio. So we do keep a pretty balanced portfolio between performing for that immediate cash flow and non-performing, which gives us more of that upside. And that's when borrower has missed their payments for 90 days or more. So typically we get those at 60% of the total loan balance. So then what we do is we're working one-on-one with those borrowers to fix and then flip the loan. So this is really the fix and flip process. I want to walk you through this here. Get my little Q&A box out of the way. So we're buying these loans all on single family homes at a discount to their unpaid balance. Again, anywhere from 40 to 60% of their total balance. And then you have the first step we do after all the due diligence and deciding, yes, these assets fit our buy box, our criteria, they're risk adjusted. We've done all our due diligence on the paperwork. Then we initiate foreclosure, not because we want to foreclose, because 90% of our portfolio actually goes through the workout process, but because it gets borrowers to come to the table. So we send what's called a demand letter. And then from there, this top flow here is where I said 90% of our portfolio falls into. So non-negotiating payment schedule with the borrower. We're generating cash flow from those payments to take it from a non-performing loan to a performing loan, which then increases the value and allows us to sell it back as a performing loan to the secondary market for a profit. The borrower might sell and pay off the loan or refinance and pay off the loan. And so I'll walk you through a quick example there. We had a borrower who came to us that was 30K behind. He had fallen on some medical issues, but once they were resolved, he went to the bank and the bank said, that's great, you can continue to make your monthly. However, that's going to be applied to your past due, your late fees. So this man was just never going to get caught up. We acquired this loan. We put him on a 6-month trial payment plan where he committed to making his monthly payments. And then at the end of that, we modified the loan. Couple of things to note here. We do not touch interest rate when we modify the loan. A lot of people have questions about that. We only work on repurposing and repackaging the past due balance. So with that 30K, we extended his term. And then other options that we could have done is some borrowers will say, hey, I'll make quarterly payments or monthly payments towards my past due balance until I'm caught up. So 6 months of that trial payment plan, he's considered, we modified the loan and another 6 to 12 months of payments to have it reclassified as a performing note. Again, all the while generating cash flow from these payments and then again, selling it back on the secondary market. The lower route is if the borrower refuses to work with us or there's a death and so it's up to the heirs, and we typically will go through that foreclosure process. Again, this accounts for about 10%, less than 10% of our portfolio. And at that point, we will sell the home if we take it back at auction. As I can imagine, you're looking around, there's not a lot of housing and everyone wants a deal. So we're really not taking back many houses at foreclosure auction these days, as many other investors are coming and bidding on these houses. And so we just get paid off in full. If we do take a property back, we do sell it. We are not in the business of holding on to rental properties. That is not the intention of the business. We are hyper focused on mortgages. So a question I get here a lot is, well, if the loan was $500,000 and you got it for $250,000, and it goes to auction and what do you get? So regardless of what we pay for it, the outstanding loan balance remains the same. So when we go to sell the loan or the borrower sells the house, we get the full unpaid balance at $500K, even though we only paid $250,000 for it. That's irrelevant. We are paid off the full balance of the loan. So steps to securing a mortgage note, really quickly want to run through this because it's not something that is very, we don't just look at Excel spreadsheet and say, these are the loans we want. That's how it starts. We give a preliminary bid, kind of like you would putting an offer on a house. We might get a counter bid, accept or reject. We'll come to some sort of agreement on pricing. And then we enter into a due diligence period. That is similar to escrow. We are pulling title, having an attorney review is it collectible in the state? Is the title made out? Is it in the right person's name? Is there title insurance? Um, is the mortgage in the right person's name, in the borrower's name? We've had that come up. Is it indeed a first position loan? Or are we looking something that actually is second? Have taxes been paid? We look at the borrower's criminal history, financial history, mortgage payment history, and what prior servicing notes. I think this is something that's left off a lot of. We try to ascertain the borrower's ability and desire to get back on track. And typically, what we find is that people have licensed servicers, your lender is required to keep a history of every time the borrower calls in, makes any sort of communication. So, what we're able to ascertain from that is if there was a health issue, a death, a divorce, job loss, something that caused them to stop paying, and did they make any attempt to get back on track prior to us purchasing this loan? Then we will, obviously check the property value as well, and then fade our bids accordingly if there's something that we find is off in due diligence, or drop a few loans if they don't fit our criteria after due diligence. And then we will close on those assets and board them. So, want to run through some FAQs I get in case studies. Why would people sell loans, especially performing loans? So, non-performing, easy. Lenders want to get those, lenders, banks want to get those off their books. It limits their ability to write new paper, write new loans, write new debt. So during high interest rate periods, they get better rates on newly originated loans. Banks are very, very good at originating debt. They're awful at managing it. So that is one reason it's easier for them to take a loss and originate new paper that's performing than staff a team that they don't even have the staff for to go through and work with these borrowers. And then as far as performing notes go, kind of the same thing. You saw a ton of loans originated at 2, 3% a few years ago, what seems like only a few years ago, and now it's actually been like 5. And now they might be performing, but there's rates are way higher and they're losing money on those loans. So for them, they can take a little bit of a haircut, sell those loans, even though they're performing, and go ahead and again write new debt at 5, 6, 7, 8%. So that's why they would sell some performing loans. If it's a lender on the secondary market, they might be looking to close their fund, they're rebalancing their portfolio, need more liquidity, or assets might not fit their buy box. So if we're working with someone, we know a few funds that only do second position. If we have second position loans that we acquire, we sell them to them. If they have first position or vice versa, or certain states we don't do business in, that might be a reason for people in the secondary market to sell. I mentioned that we look at servicing notes. Biggest misconception, and I feel like biggest learning curve in education that we face at 70 is people don't just wake up and decide not to pay their mortgage. What we have found over doing this over 600 times, this individual fix and flip process, is that it's typically job loss, health, divorce, or death that cause them to stop paying, and then not getting back on track. What could be a matter of flexibility with the bank, inability on their part. So there's quite a few different reasons people fall behind. Again, I'd say about 2%, less than that, of our portfolio are people who just wake up and say, I'm not going to pay anymore. Just want to give a little bit of a example of exactly kind of what this process looks like. So we acquired this loan in August of 23. Borrower was 9 months behind. We signed a trial payment plan with them, which included a down payment of 2 times their normal P&I, and then increased their monthly payments by 6%. So after 6 months of the new amount, they agreed to sign a loan modification, wrapping all their past due into a new agreement. So again, working on their past due balances. And then in August of 24, the borrower signed the loan modification, and we were able to sell the loan as a performing loan shortly after. So just kind of an example of, and you can see kind of over here, you have the details of that. We got a 30% discount. The loan to value, very important here, as everyone is probably worried about the housing prices crashing. All of our LTV right now is at 56% as a portfolio. However, our investment to value is around 37%. So because we're purchasing these at a discount, we're even more insulated from, a market correction. For something to drop that drastically would be unprecedented. We didn't even see that in 2008. Yes.
Somebody asks, Doreen, what happens when you own the mortgage and the homeowner does not pay the property taxes?
Yeah, great question. That's a great question. I don't think I've ever had that question come up, but
Hmm.
it's a good question. So if we find that the borrower hasn't paid the property taxes prior in our due diligence, we will probably fade our bid to account that we're going to have to pay those. So if they owe 5,000, we'll fade our bid by 5,000 and we'll pay those as part of that. Now, if they stop paying, and this is something we monitor, we actually have a company that monitors and sends us reports every month of any thing that hasn't been paid or anything that's like late. So we're constantly monitoring that. And so that we can be aware if something does go into default as far as property taxes go. Because as far as liens go, the only thing that supersedes a first position lien are tax liens. Most of the assets that we have, the property taxes are nominal. So if something does go into default, also have a bit of time. It's not something where we have to pay it immediately. We'll reach out to the borrower, we'll work with them, and then in some instances we will pay it so that we don't lose the asset. That's a great question. So passive investment options with mortgage notes. So why a mortgage note fund? So, when I started this as an individual investor and I thought this would be super passive. It is not. There's a lot of day-to-day that goes into managing these loans and the due diligence process and making sure, like you said, taxes are paid, insurance is there, everything is kind of in alignment. Maybe for one and two loans, that's not that big, but I was looking at like 50 plus loans. So what a mortgage note fund allows you to do is essentially invest in this type of asset class without the headache of managing the day-to-day. There's also profitability in varying market conditions. So as we're seeing right now, it's non-correlated to the stock market. We are not tied directly to what's going on with the stocks and bonds. Note prices in the marketplace really function just in relation to supply and demand. So during COVID, what was interesting is there was a ton of supply, but it was overpriced. However, we were seeing record payoffs from our borrowers because everyone was refinancing. Now, in this market, we're seeing a ton of inventory, which allows us to get great pricing and discounts on our assets and more flexibility to really work with those borrowers and creating those repayment plans. It's collateralized by single family homes in our case. You know, less volatile than stocks, which are very little collateral and have high volatility. And then versatility. This is something that is really important, I know, to me as an individual investor, is there's numerous exit strategies. So we're not saying we're taking this apartment building, we're going to raise this capital for it, make it nicer, and then refinance out and pay off our investors. And then we're like kind of held at the mercy of, interest rates, which we've seen not go so well for a lot of people. For us, each loan has numerous different exit strategies we can take, different ways of working with the borrower. And then investing in a fund, you're not investing in one asset. So you're not dependent on the outcome of that individual asset. Our portfolio is, I think I have a picture. Go forward to that. Here, our portfolio has 74 assets currently across 26 states. Our LTV is 59%, but like I mentioned, our investment to value is actually 37%. The value of the properties is 68 million, and the average loan balance is 415,000. And you can see down here, we are spread throughout the US. We're not, you know, there's a few states that we try to steer clear from. But aside from that, we look at everything when it comes across our desk. Okay, so we have our offerings, like I mentioned, we have this Reg A offering, which is open to accredited and non-accredited investors. This is what I would call our flagship product. That was kind of the mission behind 70 to democratize alternative investing, making it accessible and available to everyone. The the minimum lockup is 4 years. The minimum investment is $5,000, though we do start offering bonus equity at $25,000. And then it offers a preferred distribution of 8% annually but we pay this as monthly dividends. So if an investor invests in April, their interest would start accruing May, and they would receive their first dividend June 1st. So we put this money to work very quickly, making sure that our investors get paid quickly.
Somebody asks, what happens if I need to pull out sooner than 4 years?
Yeah. So prior to 4 years, well, two things. We do have a death and disability put, meaning if it's because of a death or some sort of disability, there is no penalty to redeem prior to your 4 years. If you do need to redeem for something outside of those two cases prior, there is a penalty. It just depends on at which point you redeem. So what that means is if you're redeeming in year one, it's going to be a 12% penalty. In year two, it's 10. Year three, it's 9, and year 4, it's 5. So the further into it, the less of a penalty you will pay.
Nice. So it's a tier structure, almost kind of the same, although I don't like theirs, they're a lot higher. Like somewhat the same structure as like an annuity, right? A fixed income annuity.
Correct.
But drastically cheaper, thank God. So can a 1031 exchange invest into the fund?
No, unfortunately, they cannot.
Sorry,
This
Kat.
is a question we've been asked. But these are some of the offering highlights. So it's open to like qualified and non-qualified accounts. So IRAs, cash accounts. We pay our distributions monthly.
Mhm.
We have that 3 times collateral coverage, over 70 assets in our portfolio, no management fees. And this one is a big one for us because again, when we built this offering, Chris and I approached it as individual investors who were tired of K1s, tired of being taken to the cleaners on management fees.
Oh, wow.
And so we structured it as a C Corp. So you're getting dividends, which are 1099 divs, and then no management fees because we make money after our investors make money. So we have a vested interest in the success of the portfolio.
Can the distributions be reinvested? Charles asks.
Yeah, so distributions can not be reinvested. They are paid out monthly.
So, well, Charles, not to worry about that. Like I said, even if you move it back over to the IRA club, remember you can utilize the iFlip platform so you could accelerate it and then you could jump back into a deal. I just don't know how much you're going to be investing, but for example, if it's $5,000, that's something that we could talk about as another option for IRA club clients. Many clients ask, what do I do with the distributions from 7E? For those of you that don't know this, we do have a trading platform that you can throw your money into.
What states do you typically invest in or don't
Yep.
invest in? Someone asked that, so I'll answer that one. Typically, it's not about what do we invest in. It's more we try to stay away from New York, New Jersey. If we do have to go the foreclosure or legal route, they are just super impossible and difficult to work in. So it's more that we try to steer clear of those states. Now, if we have an asset, a list that where the seller requires us to take down the whole asset list, and there's one in New York, we have a partner in New York who only does New York because we think he's crazy. No, we love him, but he will buy the asset from us for his New York portfolio. LTV and ITV, great question. So LTV is loan to value. So that is the balance of the loan to the value of the home. Investment to value is if the loan is 500K and the property is worth 700K, and we purchase that loan for that discount, and we say we paid 300 for it, the investment to value is that 300 to the 700. So the investment we actually put in to the 700 because yes, we obviously don't want it to drop below the 500 because we are very conservative in our loan to value numbers anyways. But if it does, we know we're still covered. We're still going to make money because we have that extra buffer with the discount that we took. So that's the investment to value.
Nice.
Um, when you use the term single family, does that include townhome, condo, etc.? Great question. Specifically, no, we're referring to like single family, non-detached. However, it could mean up to 1 to 4 units, like a small multi-family is technically considered still single family. Um, while you're processing on the secondary market, what about the property tax obligation, lawn care, HOA fee, etc.? So typically we're not looking at anything that has any sort of HOA fee. It's again a single family detached, not in an HOA. Property tax obligation, we look at that to make sure it's current and been paid. If not, we will fade our bid, or depending on the amount, If it's, they miss one payment, that's one thing. We can fade our bid a little bit. If we said originally to the seller, we're going to pay 100,000 for this, but they have 5K in outstanding property taxes, we'll say we'll only pay 95 for this to account for that. If all the other aspects of the asset line up. Um, Everything else is up to the borrower. So we're not the landlord. That's, I think, the probably the hardest, like the biggest difference is we're not responsible for any maintenance on the property. They are the borrower, they're the owner of the home. We are just the bank. We're just assuming the position of the bank. So when you think about it, if your plumbing stops working, or you're not going to call your bank and say, "Hey, I need you to come out here." You're going to call your landlord. So again, we're looking at single family homes, and on that note, owner occupied. So we're not looking at investment properties. We're looking at owner occupied single family homes. This is our bonus share, and let me zoom this in.
Yeah,
This is
please.
our,
I was going to ask, can you please zoom in?
yeah, so let me
There you
go
go.
up here. So we start offering bonus shares at $25,000. So you can see a $5,000 investment is going to get you 8%, so about 400 a year, an average of $33 a month. You can see it fluctuates by days in a month. But starting at $25,000, we offer bonus shares. And what that means is not only are you going to get 2,500 shares, but we're going to give you an extra 100. So you're going to actually accrue 8% on $26,000. And so you're getting 8.32. And then at the end of the 4 years, you can actually redeem the cash value of that as well as your principal investment. So you're going to be able to redeem your 25K, the bonus share amount, which is 1,000, and you'll have been paid. So your total IRR goes up with each bonus share tier. And those tiers are 25, 50, 100, and 250. And so it's 4% at 25. You can see at 50, it goes up to a 5% bonus share received, 6% at 100, and 7%, or yeah, and 7% at 250. So let me go back to this really quick.
Yep.
So this is
Okay.
kind of, you can see the bonus share tiers here. Now that you've kind of seen that visual, you'll get like, oh, okay. So the bonus share percentage, again, based on investment amount and the total IRR increasing because of that investment amount. I'm like looking at chat and the Q&A, so bear with me. I do want to mention this isn't our first rodeo. We've had 5 previous funds go full cycle, and we do work with a lot of financial advisors and RIAs. So for one of our partners in what we call our institutional space, we actually have had a track record verification report done. It's something that a third party, think of them like an auditor, comes in and they verify that we actually, in fact, met the commitments that our past 5 funds said they did, and what we say on our website is actually true. So if that's something that you're interested in, we do have that available for prospective and current investors as well. We have a vertically integrated team. I feel like that is undervalued, and I think it's something that more emphasis needs to be placed on. Everything is done in-house. We have a lot of vendors we'll rely on, but the actual asset management and investor relations is done in-house. So, if you're an investor with us and you call in and have a question about your account, your paperwork, the processes, you know who you're going to speak with. You're not going to get, shuffled around to a third party or outsourced. And then same on the asset management side, we are able to move through this fix and flip process much quicker because we have the team in-house able to move through and make the decisions quicker than waiting on a third party asset management company.
Take care, Lauren. Until next time, guys.
Thank you.
Thank you. Bye-bye.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.